Ladies and gentlemen, welcome to our Candriam webinar on the macroeconomic perspectives. Today is December 3rd, 2020, and we are going to talk about the health of the global economy. My name is Renato Guerriero, Global Head of Distribution at Candriam, and my guests are Anton, Brender, our Chief Economist, and Florence, Pisani, Global Head of Economic Research. Before starting, I would like to share with you that Candriam is doing very well. All our people are doing well, and we are working remotely in a very seamless manner. I'm also pleased to announce and share with you that our e-learning platform on sustainable investments, the Candriam Academy, has now reached more than 5,000 members. And what is even more interesting is that these members come from 30 different countries. Over the last month, we have been awarded two times, once by the UNPRI, the United Nations Principles for Responsible Investments. They have put us in the group of the top 20 asset managers because of our quality in climate reporting. And at the same time, we have been awarded by the Sustainable Index by Hirschel and Kramer as one of the most developed top 3 sustainable asset managers in the world. To conclude, I would like to thank you all very much for your trust and loyalty, because as of a couple of days ago, we have reached our peak in assets. Candriam has now more than 137 billion euros under management. So with that in mind, let us go back to the economic reality. We have had a very full month of November with the US presidential elections, very strong equity markets. We have heard the news about a number of vaccines coming and becoming available for the global population. And also we heard that United States are trying to work on a bipartisan plan with more than 900 billion to support the economy. And at the same time, the European Union is also working on a number of plans to support demand. But to get a better understanding about all of this, I would like now to hand it over to Anton.
Thank you very much, Renato. Hello to all of you. I'm going to share with you my screen and the slides we prepared, as we do usually. Here we are. So very briefly, because this is going to be a very brief overview of the world economy, a few remarks first on the shock to the global economy. This shock, it has been well commented, but just we want to illustrate it, is unseen in the recent past. You see that the fall in activity has been the deepest we've seen since World War II, and much bigger than during the global financial crisis. And if you look at the IMF last forecast, you see that the impact on world growth is going to be significant. By next year, world growth in 2021 will be close to 6% below where it was expected to be a year ago. So much for the shock, a deep shock, an unprecedented shock. I also will insist on its legacy, and its legacy is going to be, in part, a high increase in indebtedness, and in particular in public indebtedness. What you have here is the deficits, accumulated deficits over 2020 and 2021 of the developed economies. You see that 10 to 20% or more of additional debt is going to be added to public debt in those countries. And it's about to be the same in many emerging countries. So much for the global picture. And now I will very briefly go over what has been going on in China. China, as you all remember, has been the first country hit by the pandemic. And China is also the first country to get out of the pandemic and to put its economy back on track. We believe that they are close to get there. And they did so by focusing on one motto, an old one in China, relying on their own strengths. And they've been very good at it. Now, if you look at what happened in China, the fall in activity was spectacular as everywhere, but the rebound was also spectacular. And if you look at the various components of the rebound, you see what sector contributed to the rebound. You see that construction played a key role. It's a light blue line above. And manufacturing already is back also on its past growth trend. What remains still depressed, if you look at the lower charts, is the sectors that have been most affected by the pandemic, by social distanciation. We're going to see this everywhere. Hotels and restaurants, retail trade, those sectors are still not totally back on track. Now, if we look at what helped promote this situation, fiscal support played a big role in China. The public deficit has grown wider, and the focus of the support was, the bulk of the support was concentrated on the second half of the year, as you see here, and this helped the rebound in activity to take place. Now, public debt, but also private debt has been increasing. What you see here is a total flow of credit to the economy. It jumped during this year. And if you look who borrowed, you see that the corporate sector, firms have been borrowing, non-financial firms have been borrowing, but also households. And this all helped the investment in fixed assets to pick up. And if you look, for instance, at the green lines, the green bars, you see this is for real estate investment. It has sharply rebounded thanks to all the borrowing that has been taking place. And you see that infrastructure also is rebounding right now. So altogether, we believe that slowly investment is going to get back on track. What is still affected by the pandemic is household behavior. And you see retail sales have not fully regained their past growth trend. They're close to it. Car sales rebounded. And if you look at more aggregate indicators, you see that total consumption of households is still in negative territory, despite the fact that disposable income, the gray line in the middle above, disposable income has already regained most of its momentum. So the saving rate of households is falling, but is still more elevated than it was before the crisis, which means that there is still some potential for a pickup in consumption. So more so that if you look at the unemployment rate, at least the statistics that are available, the unemployment rate is slowly falling back to its pre-crisis level. So things are slowly improving, and actually they improved rather quickly. And if you look at the contribution to growth during the first 3 quarters of this year, 2020, you have it here, you see that investment has contributed, the rows, the pink bars, investment has brought its usual contribution. Actually, it contributed more than last year to growth. What is still missing is part of the contribution of consumption, and we believe that this is about to come. Altogether, we think that China will be back on its former growth trend, actually a slightly lower growth trend, but still to a 5% trend by end of this year. And this is a big difference with the rest of the world, which altogether means that growth is going to be somewhere around 2% this year and a sharp rebound for average growth next year. But there is a big basis effect, of course, something close to 10%, 9%, 10% next year, at least if we're right in our assumptions. Now, at the same time, China has been refocusing its economy on the domestic front. They have been letting the yuan appreciate sharply against the dollar. They're distancing themselves from the US, and they've been actively promoting a new free trade area that goes over the Pacific, to which many developed and emerging countries are part of. And this represents close to 1/3 of both population and the world economy, and also of world trade. So China is moving on its own path, using its own strengths, and we believe that this is one of the consequences, not only of the pandemic, but also of the policies that Donald Trump has led over the last years. Now, This being said, we move to the US economy, and our title says that we believe that uncertainties are dissipating. That is, we know who has been elected, even if Donald Trump pretends he doesn't know exactly, but still, we know who's been elected president, but you still have many other uncertainties. Now, if you look at what happened here again, you see that in Q3, here it comes. The rebound has been spectacular, less spectacular than in China, but still a sharp pickup in activity. And if you look at what contributed to this rebound, you see that residential investment is now well above where it was a year ago, a sharp rebound in residential investment, thanks to the very low mortgage rates. But what is still weaker than it was a year ago is consumption, and we'll come back to that. Now, when you look at investment, one component, intellectual property rights, research and development, has not fallen at all. It didn't increase much, but it hasn't fallen. And this represents 1/3 of investment. On the other hand, if you look at the other 1/2, of investment, if you look at the second half, equipment investment, it has not been back. It is not yet back to where it was a year ago. And this is a big difference. What has rebounded is investment in info processing equipments. What is still lagging well behind is investment in transportation equipment. Remember that planes are part of this, but not only planes. This is lagging as far as investment is concerned in the US. Now, what has been going on during those 3 quarters? We tried to summarize it in 2 slides. First thing, if you look at the behavior of households, it has been affected by the pandemic. Social distanciation led them to spend less. But if you look at the available consumer spending trackers on the left-hand side, what you see is that low-income households are already back on track as far as spending is concerned. They spend about what they did before the pandemic. Those who are lagging behind are the high-income earners. They are still spending well below what they did before the pandemic. And if you look at the right-hand side, the lowest slide, it tells us what kind of goods or services households are buying less. And you see that it's mainly accommodation services, recreation services, transportation services, all those services rendered by the affected sectors of the economy. And this is due to the fact that high income earners are spending less in restaurants, in hotels, on airplanes, and so on. The consequence has been devastating for those who work in those sectors. And what you have on the right-hand side is the impact on employment of the shock. And when you move to the right, you move to sectors where hourly earnings are higher. And what you see is that all the job destructions took place in the pink part of the chart, in sectors where you have people who earn much less than the average hourly wages, hotels and restaurants, waste industry, food services, and so on. Those sectors have been hit badly by the pandemic, and a lot of jobs, close to 20 million jobs, have been destroyed in those sectors. So what has been helping the economy is that the government has been jumping in right away from the very beginning. It was a bipartisan approach, and it was accepted both by the Democrats and the Republicans. The government has been borrowing the savings saved by the higher income earners and used those savings to compensate. To compensate the lower income earners. What you have here is the deterioration of the budget balance, more than 20 GDP points, and the bulk of this went under the form of transfers to persons, increased unemployment benefits, paid checks given to lower income households. Altogether, this has allowed the income of households to increase despite the huge increase in unemployment. And since consumption has been decreasing, altogether, savings have been exploding in the US, household saving. Now, the result, you see it, is that on one hand, households have been saving, on the other, the government has been borrowing. And of course, the two things are the two sides of the same coin. Now, what happened after this took place, that is since October, is that the pandemic has been rebounding. And if you forget about the number of cases, because you have a lot of discussions, but if you look at the people who are occupying hospital beds, you see that the number has been increasing during the month of November, and I think we reached 100,000 today or yesterday. So that the jump in the explosion in the pandemic is not just in numbers, it's a fact. Much more people now are in hospitals than we ever had them in the months before. And this is true all across the US. This is also new. Remember, at the beginning, it was only New York. Now it's all the states, and in particular, those who are in the northeastern part, where a lot of rallies have been taking place during the election campaign. Now, we still believe, thanks to the perspective of mass vaccination, that it's possible for the US economy to be back on its former trend by the end of next year, not this year as in China, but by end of 2021. If we are correct, growth this year is going to be somewhere close to -3%, -4%. And next year, it will be on average over 2021, close to 4 or 5% point above what it has been in 2020. So a significant rebound in activity and normalization. Now, will this lead to an increase in employment? Sufficient? Remember that right now, you have about 10 million jobs who are missing, who have been destroyed, who are still missing in the economy. And will this rebound also be accompanied by a fall in the public deficit, a decrease in household financial savings? This is a big question that we'll have to try to answer. But just to insist on the various risks that are still in front of us, the first risk concerns the normalization of business investment. Business investment seems to us to be the less uncertain part of domestic demand in the US. Firms have been borrowing a lot. You see it right here. You see the green line going up. Is the debt to GDP ratio of the non-financial corporate sector a jump in borrowing by non-financial corporations and by firms in general? They have been putting most of this money aside. So it's not to finance an increase in investment that it didn't take place. It's just to have money set aside just in case they would need it. So that's one first positive. Second positive, the programs put in place to support the economy will compensate for part of the profit losses, in particular of the smaller firms. You've heard about the so-called Paycheck Protection Program. This program was supposed to lend money, to help lend money to small firms, but those loans could be and have been converted for a part in grants. And this, of course, is going to help firms to face the present situation. Now, what you see on the chart is that without these programs, during the three first quarters of the year, firms would have lost more than 600 billion of profits, billions of dollars. In fact, thanks to the PPP, they may lose only 260 billion of dollars, which is makes a sharp difference. And last thing that makes us rather optimistic on investment is that the so-called affected sectors, restaurants, hotels, leisure services, and so on, do not occupy a big share in investment. So altogether, we believe that investment should normalize over the next year. Now, what is a problem in the short term, and Renato mentioned it, is it in its introductory remarks, what is a problem in the short term is unemployed people. All the increased benefits, the checks and so on, were exhausted either in July or they will be exhausted by end of December. And without this additional support, this is what we illustrate here. The risk is just that those the unemployed and the lower income earners will just lack the wherewithal to consume as they usually did. They will drag down the economy. Without a quick support, they will drag down the economy. And we did some arithmetics here. Even if you assume that social distanciation recede, which is our assumption. So if you move along the yellow line, without additional support, this is what the yellow line describes in the short term, well, what we will see is growth to be 1.5, something around 1.5 GDP points below where we assume it to be in our back to normal by the end of next year scenario. So that's one first thing. Short-term support to the unemployed is a need for the US economy. It may pass. I'll come back to this in a minute. Second thing, even if in the short term policy is doing what it should, you cannot control the behavior of households. And the pandemic may have changed part of this behavior for more permanently than we assume. What you have here is a share of e-commerce in retail sales. And you see that during the pandemic, it jumped in the US. Now, will it go back on its past trend, or will it stay at its very elevated level, the one it has reached? We just don't know, but it's something you cannot totally exclude. And remember that $1 of sales through e-commerce, to sell $1 through e-commerce, you need something like 6 times less people than you do during the through the brick and mortar retail outlets. So it's a huge difference. And that could mean that the retail sector, who normally creates jobs in big amounts, may not create jobs at all during this recovery. That's one risk, a change in the patterns of buying. The second risk is not only how you buy, but what you buy. What we try to quantify here is a shock on consumption, on the structure, the patterns of consumption by households. We assume that for the affected sectors, they don't resume their past consumption behavior. We assume that they consume 10% less of travel services, restaurant services, hotel services, and so on. And to compensate, we assume they will buy more food directly and buy some other goods. And we made the whole shock balanced in terms of total spending, just a shift in spending, less services, more goods. And the fact that you need much less jobs, you create less jobs to produce the goods than to produce the services. This shift, the way we quantified it, would subtract 1 million jobs over the coming year to the US economy. And that, of course, is a big amount. Now, the good news is that not only that Joe Biden has been elected, but that his program comes very much at the right time. Donald Trump did things that were not needed by the US economy when he did them. But what Biden has in its program is badly needed right now. So the timing is perfect. He wants, of course, to extend unemployment benefits and aid to state and local government. This is needed. But in the medium term, he has a Build Back Better program. And this program is precisely meant at creating better jobs in the US economy through various measures, investing in green, in digital infrastructures, and so on. And people who've been trying to quantify the consequences of this program come to the conclusion that it may add 1 point of growth each year over the next 4 years. And this is precisely what is needed just to face the challenges, the risks I've been mentioning. Now, of course, as you know, there is no majority right now in Congress, and especially in the Senate, to support such a program. And we'll know beginning of January if the Democrats can win a majority there after the Georgian elections. But even if they don't have a clear majority in Senate. We tend to believe that there is a good chance that over the coming months, some bipartisan support may be garnered by the program, at least some of the measures of the program, so that we're pretty confident that the economy is going to be supported in the coming year by additional measures, not only the short term, but also more longer term measures. And this is, I repeat, badly needed. Now, this being said, even if the economy is back on track, even if the program of Joe Biden is put in place, which is a big if, I repeat, as the legacy of the crisis will be deep on the financial sector in particular. There will be bankruptcies, and you may fear that those bankruptcies could harm the financial system, and particularly the private banks, could be deprived or not willing of the means to lend more. So that could be something like a credit crunch after the bankruptcies. We believe this risk is very small. One of the reasons is that banks have been provisioning huge amounts right after the beginning of the pandemic. And we believe that they are in a good shape with those provisions, a good enough shape to absorb the shock. And just to convince us and convince you of this, what we did, we ran a very quick arithmetic exercise trying to shock the various components of the assets banks are holding, assuming a deep deterioration of the economy, something associated with a 10% unemployment rate. And if you look at the bankruptcies that are usually related with a 10% unemployment rate, that is twice as much as what we expect to be in place by the end of next year, you see that the losses would be significant, of course, but given the provisions that are in place, it would still, this shock is very pessimistic, leave enough equity. The capital ratio of banks would still be sufficient for them to keep lending if it's needed. Now, that's one of the legacies. The second legacy is a huge increase in public debt. And this increase in public debt is just, as I've said before, and here we go until the end of next year, it's just a flip coin of the increase in saving by households. So two things go together. And this is going to imply a sharp increase in the debt to GDP ratio of the US government. And what you see here is that this jump, this is a CBO estimate. The US government is going to have more than 3 trillion of additional public debt by the end of next year due to the pandemic. This is a big amount. And at the same time, again, this is the other side of the coin, households, deposits, and money market funds. Deposits with banks or with money market funds are going to sharply increase, and they already started to do so. Now, if you look at how the public debt of the US government has been absorbed up to now, there are a few remarks that have to be made. First, a lot of the issuance up to now has been short-term bills. You see that the amount of notes and bonds has been rather marginal up to now. And I think it's continuing. Now, and if you look at how those issuances have been absorbed, they've been absorbed mainly by money market funds and by the Federal Reserve. And actually, if you look at the lower chart, you see that the Fed has been heavily buying the bonds and notes part of the issuance and left the bills to banks and to money market funds. So actually, the available bonds and notes for the private hands have been drawn down. You have less of them, despite the issuance by the government than we had before the crisis. Now, if you look at how this has been financed, you see that the central bank has been buying bonds and notes, and this has been financed by an increase in bank reserves. And this is a counterpart of the deposits households are making in their banks. Also note that the Treasury has been putting a significant amount of money aside. It borrowed a lot but it also has been putting a lot of money aside up to now. So it has where to spend from. This being said, and that's what I will end with, the amount of deposits held by households has never been so high in the US economy. You have it as a share of GDP. It's a yellow line, it jumped. And we believe that this is not a problem per se, but it will imply in a way or another a rebalancing. If you just think of this in terms of portfolio, the amount of liquidity in households' portfolio has been increasing hugely, and the rebalancing will take place, we believe, by an upward pressure on the other asset prices. Now, the Fed may try to control this upward pressure by slightly allowing long-term rates to drift upwards and make the holding of bonds a bit more attractive. But at the same time, it cannot go too far in that direction. So the Fed will have to strike a balance, and we believe that the team, Janet Yellen, Jerome Powell, are very able to strike this balance. But we believe still that in the medium term, in the coming year at least, asset prices will be under upward pressure, both real estate and equity prices. Bond rates will slightly move up to help, release some of the pressure, but not much. So our view is that there will be an upward slope, slowly building. The slope will move a bit higher, the slope of yield curve, and we're still confident on the capacity of the Fed and the Treasury in the new team to handle this situation. So much for the US, and I give the floor to my colleague, Florence.
So, thank you very much, Anton. So
I'm trying to close my screen. Go ahead.
Here we go. Should work. Okay, here we go. So we move to Europe, and if we look at what happened in Europe, you see that the shock in the second quarter was pretty deep, minus 15%. Now, the good news is that there has been a rebound that was pretty quick, as in the US in the third quarter. You see that at the end of the third quarter, we were just 4% below year-ago level, which is pretty good news. Now, the second thing that is important is that this shock has been uneven. If you look at what happened across countries, you see here GDP growth rates on a year-on-year, and you see that 3 countries, France, Italy, and Spain, have been hit much harder than others. You see in particular that the shock in Germany or in the Netherlands was much milder than in those 3 countries. So first thing that is important is a pretty strong shock and an uneven shock, and I will come back to that. I think it's something we have to keep in mind. Now, second thing that is important, if we move to the next slide, is that if you look at what happened on the employment side because of the shock, you see here the shock on growth, and you see what I've just said, a deeper shock in Spain than in Germany. But what even more striking is that the shock on employment has been much deeper in Spain than in Germany. You see that in Germany, employment has barely declined by 1%, while in Spain, it shrank by almost 9 percentage points. Now, if you compare Spain with other countries, you see also that the shock in Spain was much deeper, not only in terms of GDP growth, but much more even in terms of employment. You see the contrast, barely any decline in Belgium of employment, minus 1%, minus 2 to 3% in France and Italy, but a big shock in Spain. So clearly much deeper shock on employment on the Spanish side. So not surprisingly, if you look at the behavior of disposable income, you see here's the shock of employment, which is spread and very uneven across countries. You see the shock on disposable income, and you see that in Spain, disposable income of households have been declining by 10%. By contrast, if you look at the Netherlands or Ireland, you see that disposable income of household has even increased because of pretty generous transfers to households. So despite the fact that everywhere we put in place short-time working scheme in Europe, even in Spain, you see that the shock on some economies has been much deeper, with disposable income contracting sharply in some of these economies. Now, second thing that is important is that some countries, we believe, will have more difficulties than others to come back to normal. And just what we did is just compare the data which were available for the third quarter in France and Spain. So if you look at the shock in the second quarter in France, you see a deep shock everywhere, but you see that most sectors were almost back to normal in the third quarter in France. So the shock, for example, in food and accommodation services was much milder in the third quarter. Instead of minus 50%, we just had minus 10 to 15%. Now, if you look at Spain, you see that most sectors are still under heavily downward pressure. You see that arts entertainment was still 30 to 35% below year-ago level. So some sectors are still deeply underwater in Spain. Now, unfortunately, as you know, there has been a renewed surge in cases in most European economies. So the good news is that with the new lockdown and the new measures that have been taken by governments, new daily cases have been faltering over the last days, which is good news. But still, the lockdown implies there will be another shock on the economy in the fourth quarter. So to gauge the size of the shock, what we did is look at real-time data that are available. And you see here, for example, Google mobility data. And you see that the deterioration has started, in fact, beginning of October and until at least end of November. So if you try to assess the shock on the economy with those data, it gives you a sharp fall again of activity in the fourth quarter. Activity would be minus 15% below year-ago level. It's a bit milder than during the first lockdown, but it's still a very significant shock on the economy. Now, that being said, we have, I think, to be rather careful using those data. They may overestimate the shock on the economy. Remember that there were a lot of differences between the two lockdowns that happened. During the first one, schools were closed. During the second one, most schools were still functioning. And also, we put in place some click and collect measures to help alleviate the pressure on some businesses. So clearly, we do believe that the data, real-time data from Google, do overestimate the shock, although there will be a decrease in growth, we believe, in the fourth quarter. Now, if you look at PMI indices, they just tell you the same story. There is, again, a shock on the economy, but the shock is milder than during the first lockdown. If you look at the deterioration of services in the service industry, you see that for the Eurozone as a whole, we moved back to 40, but it's still way above the below 20 levels that we reached in April of this year. So clearly a shock that should be a bit milder than during the first lockdown measures. So our scenario, you see, we did not really change the growth trajectory we have. We still believe that by end of 2021, the European economy could be back or closer to the reference trajectory after, as you see on the chart, a fall again in the fourth quarter, and then some recovery in the first quarter. Now, this is an optimistic scenario, and there are a lot of questions, of course, around this scenario. Now, the first thing that we have to keep in mind is that even if we are back on track for real GDP growth, we do believe that there will still be a lot of missing jobs and that the labor market will not be back to its previous trajectory, to its previous level in terms of employment rate as before the crisis. We think that a lot of missing jobs will still be missing even if we are back on track in terms of GDP level. That's the first point. And the second thing is that, remember, this is a Eurozone average. We do believe some countries will have much more difficulties to get back on track than others, and I'll come back to that in a minute. So first point, there will be some missing jobs by the end of next year, and unfortunately the missing jobs are in places where the unemployment rate was already pretty low at the end of last year. If you look at Spain, you see there's 4 million missing jobs right now. And if you look at Spain, the level of unemployment was way above the average of the euro area before the crisis. So clearly the countries that have been hit the most are also countries where unemployment was already high by end of last year. Second thing that is important, this crisis is hitting more small companies. And as you see, the share of small companies in employment is rather important. It's the case all across Europe, but it's especially the case for southern part of Europe. You see that small companies are employing 55% to 70% of total employment in Spain, Italy, Portugal, and Greece, much more than in the rest of the euro area. Now, if you look just at the shock as the sectors that have been hit the most by the pandemic, you see that their share in employment is very elevated, especially in Greece. You see that in Greece, it's 18% of employment that it is really at risk, that has been shocked. And you see that even for Spain and Italy, it's 9%. It's much more than for Belgium, the Netherlands, or France. Now, second thing that is important, this shock will also deeply affect countries. There will be discrepancies or divergences within the countries, because the most impacted sectors are employing a lot of less educated workers. So if you do just a calculation for the euro area as an aggregate, you see that the impacted sector represent 27% of GDP, 34% of total employment, and almost half, 47% of less educated employment. So clearly the shock is going to hit small companies, but also less educated workers. And as you see, this is especially the case in the southern part again of Europe. In Portugal, there is 40% of less educated workers. In Spain, almost more than 30%. So here again, a shock heavily concentrated in the southern parts. So what could happen in the euro area next year? And do we stick to our scenario where we are back on trend? We do believe that some people are worried about investment. We are a bit less worried about the investment being under shock. And the reason why we are a bit less worried is that if you look at the size of investment of the shocks that have been most affected by the crisis, you see that this sector are usually small moms and pops shops, as we small companies, and their size in total employment is relatively moderate compared to their size, for example, either in employment or in operating surplus. So you see that their size in total investment is around 4% or 6%, but it's much less than their size in total operating surplus or even in total employment. So we don't believe that the shock on investment is going on average to be very significant. Now, the second thing is that many countries have some countries at least have put in place also measures to reduce the size through subsidies to companies, the size on their operating surplus. And you see that this is particularly the case in the Netherlands, but also in Australia. There has been a lot of support from the government to shops in order to preserve their operating surplus. Now, this is not the case everywhere, which means that in some countries, again, there could be a deeper shock on investment. And one country, of course, we are worried about is still, again, Spain. If you look, what we did is compare the size on corporate operating income in Germany and Spain, and you see that the shock in Spain has been much stronger. If you look at the operating losses in 2020, this will represent 13% of investment in Germany, but 36% of 2019 investment in Spain. So a shock that is 3 times bigger in Spain compared to Germany in terms of loss operating income. Second thing that is important, we do believe that some countries could have more difficulties to get back on trend for a couple of reasons. First, even if there is mass vaccination, social distancing could be lingering. As Anton said, there could be changes in household behavior. Now, if that's the case, some countries will be hit harder than others. And those countries, again, are the same usual suspect. You see that in Greece, for example, the consumption of impacted sectors as a share of GDP is 20%. This is 3 times bigger than, for example, the consumption of impacted sector in Belgium. So if social distancing, if there is still a protracted social distancing and an impact on demand, the shock on some economies will be much deeper and harder to feel by the end of next year. Second thing that is important, there is going to be some bankruptcies. We know that. Now, bankruptcies could have a negative impact both on employment and on the capital stock. Now, there is a study by the ECB that was released a week or two ago. And in this study, what the ECB is doing is the ECB is looking at the possible impact of bankruptcies on employment and also on the stock of capital. Those companies that are the most vulnerable, of course, are the companies that are more leveraged and that will have more operating losses during the coming quarters. And you see that in Spain, employment at risk represent almost 14% of total employment. It's much more than in France or Germany. And you see that the capital at risk is also much higher. 6% of the capital stock is at risk of being scrapped in Spain compared to less than 1% in Germany. So clearly the shock has been really uneven. Now, of course, there has some positive news that could partly help offsetting those shock. And one of the things that people are counting on is the so-called Next Generation EU plan. This is, remember, this is a 390 billion euro grants, mainly concentrated on countries that have been more impacted. You see that if this plan is voted, and it has not been voted yet, but normally Italy and Spain will receive 4 to 5% of their GDP, and Portugal and Greece 7 to 9% of their GDP over the coming years. So this could help alleviate part of what happened during the COVID crisis, part of the shock. That being said, this is not a game changer in the short run. Remember, the plan has not been voted yet. It will not be implemented at the earliest mid-2021, in the middle of next year at the earliest, and it will be spread over a couple of years. So clearly, it's not a short-time boost. It could add 1 to 1.5 GDP points. It's not nil, but it's not a game changer given the size of the shock on these economies. Second thing that is important, before the crisis, we already had some divergences within economies. And you see what happened. What we did is compare the GDP per capita of countries compared to Germany. And you see that divergences for Belgium and for France, even more, has been growing since the beginning of the 2000s. And you see that it's even worse, of course, for Italy. You see the same for Spain. The gap of income was reducing during the beginning, from the beginning of the 90s to the mid-2000s. And again, the gap has been rising since the mid-2000s with Spain. So clearly, this shock is going to increase, again, divergences between European countries, which is pretty bad news. Now, the second thing that is important, the crisis is going to leave some legacy, as in the US, in terms of public debt. As you see here, we did the same thing as for the US. We looked at the public deficit, and the counterpart of it is a household's surplus, more savings, financial savings by households as a counterpart of the government deficit. The consequence on public debt is that even in an optimistic scenario where we are back on trend by end of 2021, you see that the debt at the euro area level is going to increase by 1.3 trillion euros over 2020-2021. And if you are a bit more cautious about the trajectory of the economy, you have here the European Commission forecast. You see that the European Commission is forecasting an increase in public debt of 1.6 trillion over the next 2 years. Now, is this an issue for interest rates? We don't believe so. Remember, the ECB is there, and we believe the ECB will still be there next year and continue to buy a lot of public bond issuances. So what you have here on the left-hand side of page 54, you have the net government bond issuances, and the square, the blue square, is net issuances after ECB buying. assuming the ECB is going to announce, we believe next week, an increase in its PEPP program of 500 billion euros, of an additional bond buying of 500 billions. If it announces this, it will mean that for most countries, for almost all countries, net issuances after ECB bond buying will be negative. So the private sector will not have to absorb a lot of public bond issuances, despite the fact that public deficit will still be wide open in 2021. So we do believe interest rates will stay at moderate level in Europe, and we don't fear a big rise on long-term rates. Now, the second thing that is important is that we do believe there is a need in some countries of additional support. If you compare what happened this year, you see that Germany has been supporting its economy, that the fiscal support in Germany has been more than 8 GDP points, much more than in Spain. Now, what could seem paradoxical is that if you look at whose economy is going to see the biggest rise in its public debt to GDP, it's not Germany. You see on the right-hand side, you see that Spain, France, and Belgium, and Italy also are the countries who are going to see the biggest rise in their public debt to deficit. And this, of course, is pointing the attention, is turning the attention to the fact that for public debt to be sustainable, what matters is not only the public support, but it's the growth rate of the economies. So what we did on the next slide is look a bit further ahead at public debt trajectory. And just to explain what we did, I will illustrate this in the case of Germany. So what you have here is the dotted line is a pre-crisis reference of German real GDP. And the rate of growth was around 1% in real term per year. Now, Germany, before the crisis, had a primary surplus of around 2 GDP points, and the debt trajectory was more than on a sustainable trajectory, clearly. It was only at 60% of GDP below the crisis, and it was going to trend down to below 40% in the middle of 2025. So clearly a public debt that was on a sustainable more than sustainable trajectory. Now, what will happen with the crisis, even if we go back to normal in terms of GDP by the end of next year, you see that public debt will be a bit higher, but again, nothing to worry about, still public debt that will be around 60% in the middle of 2025. Now, the worst case scenario would be a case where the potential rate of growth of Germany would be durably lower. And in that case, of course, Germany will have more difficulty to rebalance its budget. So it will take more time to be back to a 2% primary budget balance, which means that the public debt will be a bit more elevated than in the green scenario. Now, if you look at Germany, nothing really to worry about, even if the rate of growth, or the potential rate of growth, was a bit lower. Now, what's more worrying, if you look at the other countries of Europe, of the Eurozone, and here you have the case of France, Italy, and Spain, and you see first that in the green scenario for all these three countries, we will still be in the middle of 2025, almost 20% above the previous trajectory, whatever happens. So even in a favorable scenario, where we have no shock on potential growth, you see that the debt to GDP is going to be 20% higher. Now, if we are in the rate scenario, and if the countries do not react, do not retrain people, do not make effort to invest more, then there is a risk, of course, of having durably lower potential rate of growth, and this will put the debt trajectory on a much less sustainable trajectory for these three economies. So what we believe is that the European Green Deal, so-called Green Deal and Recovery Fund, is a very good news for Europe. It's a first step towards more solidarity, but we believe that in the coming years, we will need to deepen further solidarity within the euro area in order to preserve the integrity of the euro area. So on this, I will hand it over to Renato.
Thank you very much, Florence, for your insights on the European Union. And I also noticed we have just received a question for you directly. And the question is, why do you think Spain has been the hardest hit country? And the person sending the question acknowledges that there's a lot of small companies and there are a lot of sectors that were very sensitive to COVID in Spain, like tourism and hospitality. And the question is, but there are other countries like maybe like Greece, who is also very exposed to hospitality and tourism. So this is the question for you, Florence.
Okay, so I will try to answer. Two things. You have the structure of the economy, but as you said, the structure was not very favorable in Greece. If you look at tourism for Greece, the share of tourism is even higher for Greece, for the Greek economy, than for Spain. Now, I think also the support in Spain has been way below other economies in the euro area. If you look at Germany, Germany has put more than 10 GDP points on the table. France has also put a lot of support on the table. Spain has put much less. If you look at the support provided by the government, it's 3.5% of GDP. So it's a third or a fourth of the support put by other governments. And if you look further ahead, the German government has announced it will double its support next year, which is not the case for the time being for Spain. If you look also at the short-time working schemes, Spain has extended it, which is good news, to beginning of next year. Germany has announced it will extend the short-time working scheme for whole 2021. And of course, it's for households, it secures, you have much less insecurity if you know that you will have short-time working schemes available for 12 months and not just for 1 more month. So I think that government policy matters, and here Spain has been lagging behind compared to other European countries.
One additional word, I think that the pandemic has been a bit more controlled in Greece also than in Spain, and that makes a difference too to the hit to the economy.
Yeah, absolutely. And I have now a question for Anton that is more on the US economy. It looks like there are a lot of good news for the US economy. Maybe people will come back to spending. There's some people have been saving, and there's been a lot of fiscal response in the US. So the question we have from the audience is, do we see a risk of inflation in the US economy for next year?
Well, it's also a very good question, and we don't believe there is a risk of inflation coming soon in the US. Why? Just because, remember, one of the things central banks have proven to be the most able to control is inflation. That is, they can increase rates. And I don't think that the Fed would refrain from increasing rates next year if inflationary pressures arise. If this is the last thing they have to, the only thing that can control inflation, they would do it. But before, remember that all the support that we talk about is to prevent deflation. So the government would also remember that Joe Biden in his plan has also an increase in taxes and so on, so that you can prevent inflation from picking up, both by using monetary policy, and the Fed would not hesitate to do it if they believe it's needed. But the government can also contribute, by increasing taxes. And right now, the story is totally the opposite, providing support to the economy and keeping rates low. But this can be reverted, and we don't see, a surprise jump in inflation coming about in the coming year, and not even the year after, I believe. And the Fed would control it. We don't believe that the Fed would let inflation explode. They will let it go above 2%. They've said it, but not to 4%.
Thank you very much, Anton. Time is clicking, and we had announced 1 hour. So I want to thank Florence and Anton for their insight and their knowledge, because as William Penn, a descendant of the family behind the Pennsylvania state, once said, knowledge is the treasure of wise people. So thank you all for having spent this hour with us. I would like to draw your attention on our candriamoutlook.com site. On this site, you will find every day a question to our financial experts. And hopefully this question will allow you to get a better understanding of the markets for the next year, 2021. Thank you again for your participation, and I look forward to speak to you again.
Goodbye to all of you.
Bye-bye. Thank you.